Hey guys, Ben here from Making of a Millionaire, your online publication for all things personal finance related. This is my first live stream, and what I'm hoping is going to be a weekly kind of live show, I guess, running down some of my favorite headlines of the week, financial headlines, reviewing some of the stuff I've written on Making a Millionaire on my website recently, and also going to have some segments on the worst headlines of the week, which is going to feature some of the worst financial advice that I've seen recently. And I'm going to be taking and answering a lot of listener questions. Although I do just want to quickly start off too with a little bit about me and my background. If you're not familiar, if you haven't followed any of my writing, I've been writing about personal finance for about a year and a half on Medium. I have a publication there called Making of a Millionaire. I am not a financial planner. I don't have any licensing for investments or anything like that. This show will not be about giving specific investment advice about buying a particular stock or buying a fund or anything like that, or an insurance product. I won't be talking to the specifics like that. I'll be talking more at the macro level about managing money, investment philosophy, and the decision making about financial decisions, and hopefully kind of helping folks put together their own structure to actually decide how they're going to make financial decisions. So today, I'm going to start off with my favorite headline of the week. This is an article that I have not written, but I've been reading. I read a ton of personal finance related content. And I saw one this morning actually from Axios. The headline of that is even baby boomers are behind on retirement savings. So this one kind of caught my eye because we always see a lot of attention paid to millennials and how bad millennials are at saving and making financial decisions. But we don't really see a whole lot of attention paid to older generations. Certainly not scrutinized in that same way that we seem to want to bash younger people for their financial decisions and buying avocado toast, etc. And the reason I kind of like this subject is because it reminds us that everybody struggles with financial decisions and saving and retirement and all that. This isn't a new problem. People have been struggling to save enough money for retirement for generation now. So here's the kind of the headline information is that according to one survey that Axios had got their hands on, that found that only baby boomers on average had only saved about 30% of the recommended amount that they should have saved by their age. So what they're using when they say should have saved, what they're referring to is Fidelity, which is one of the largest kind of asset managers, financial institutions in the United States. They've put out a kind of a rule of thumb for how much you should have saved for retirement at different ages in your life. So, for example, they say, by the time you're 30, you should have saved at least your annual salary. So, if you make $100,000 a year, according to this rule of thumb, by 30 years old, you should have saved $100,000. By 40 years old, you should have saved 3 times your annual salary. By 50, you should have saved 6 times. And by 60, you should have saved 8 times your annual salary. And by 67, you should have saved 10 times your annual salary. So if you're a baby boomer, you're 67 years old. According to this, if you make 100 grand, they would recommend that you have saved about $1 million by that point. And so given the average salaries and average age of the folks in the baby boomer generation, which typically runs, I think right now, baby boomers for age range is about 55 to 75, if I'm not mistaken. It's recommended there, using that rule of thumb on average, that they would have saved $456,000 by this point, the average baby boomer. And what they found was they only had on average $137,000 saved. So that is a substantial drop off from what they should have. And really, this is a problem, an especially bad problem, retirement savings for that generation in particular. If you look at the generations below, Generation X, and particularly millennial generation, which I am in, if they have a shortfall of retirement savings at this point in their life, yeah, it's bad, but it's not quite as much of an emergency it is for in the baby boomer generation, because this generation, the older generation, does not have the years to make up for a saving. So The time they should have been saving was the past 30 years. And the fact that in the past 10 years, we've had one of the largest bull run markets in the US stock market, possibly in history, depending on who you ask and how you measure the data, but certainly an historical run up in stock increases in the last 10 years. And still, this baby boomer generation who was in their prime working years during this bull market still don't have nearly what they should have saved for retirement. So I think, really the result of that is going to be one of two things. One, this generation is going to have to delay retirement significantly, because even if they begin saving aggressively now, they don't have the years to retirement to take advantage of compounding investment returns. And really, given their age and where they are in terms of retirement age, it may not be recommended for them to aggressively invest in the stock market at this point anyway. The time for them to do that was when they were younger. Investing, if they go all in and invest heavily now in the stock market and there's a crash or a bear market, that could make things even worse for them. So it kind of puts them in a real between a rock and a hard place kind of situation. So what that's going to mean then is this generation is going to push back retirement by many years. Some people then at that point may not ever be able to retire or have to work until their 70s or 80s. That's really actually the best case scenario. The worst case scenario then would be that they are physically unable to continue working at a certain point if their health does not allow them to do so. And if they don't have the retirement savings that they need, basically they're going to have to really scale back on their lifestyle significantly. And they're likely going to have to rely more on family members and government assistance during their retirement years, because they don't have the funds available. So I really think the moral of this story here, and why I wanted to highlight it, is that every generation in basically every country in the world struggles significantly with savings. All people, personal finance, saving, retirement is something that everybody struggles with. It's not just for young people. Everybody is kind of in the same boat in that regard. So that is kind of what I really like about the moral of that story, is that this is hard. It's hard stuff, and that is part of the reason why I'm putting together right now an online course to help people navigate this kind of situation. So where they'll be able to basically do this course and come away with a blueprint of how to pay off your debt, what order to pay off your debt, how to build an emergency fund, and how much you need to be putting away every month, depending on how old you are and when you want to retire, so that you don't find yourself in a situation where you're 60, 70 and not able to retire because you don't have the savings. So it's difficult, but I'm hopefully that this very optimistic. This course is going to make a blueprint for folks who really just need that help. And really the target people I want to find in this is, folks who can maybe not necessarily afford or want to put down the money for a fee-only financial advisor, which can cost, thousands of dollars to get a financial plan together from a financial advisor. This would be in the few $100 range for somebody who just needs to get going on it, needs a little bit of motivation, and just needs the general blueprint. So I'll put a link to that below in the description of the video. Check it out, and because I do think it will help a lot of people. Next segment is going to be, so that was the first segment of article of the week or headline of the week. The next segment here will basically be reviewing my favorite article that I've written recently. So I write about 3 to 4 personal finance articles per week. And each week here, I'm going to share with you the favorite thing I wrote that past week. So this week on Making a Millionaire, I wrote a story called Is the Stock Market Efficient? So really the best definition that I've heard of what is considered the efficiency in the stock market came from a 2003 paper titled The Efficient Market Hypotheses and Its Critics. So it was defined there as when prices, and we're talking about stock prices, fully reflect all known information, and even uninformed investors buying a diversified portfolio at the tableau of prices given by the market will obtain a rate of return generous as that achieved by the experts. Translation, that really kind of means two things: that if the stock market is efficient, that it's impossible to beat the market. And the only sensible way to invest is to buy the whole market through low-cost index funds. If the stock market is inefficient, then that would imply that it's possible for stock pickers and active managers of mutual funds to pick and choose the good stocks and leave out the bad stocks to improve your overall return on your investment, right? If the market's inefficient, you should be able to pick that, and timing the market should be an achievable activity. So the question really remains then, is the stock market efficient? And there's been a ton of research on this back and forth either way. There is no real consensus in the academic community on the stock market efficiency question. My take, I've read a number of these papers. I think the big takeaway is that it likely is somewhat efficient. I don't think we can definitively say that the stock market is perfectly efficient, but we can say, I think pretty safely, that the stock market is relatively efficient. And really, the only way to judge this is to go and look at the data. So if the stock market is inefficient, we just said, active managers and stock pickers should be able to beat the market with some consistency. So I actually we looked at the Standard & Poor's has collected data annually on how active managers, stock pickers of mutual funds, have performed against their benchmark stock market indexes. Each year they collect that data. And what they found is that in the US, 82% of active managers underperform the S&P 500 over the past 5 years. All these stats are over the past 5 years. 90% of active managers in Canada have underperformed the Toronto Stock Exchange Index, and 80% of active fund managers in Europe have underperformed the S&P Europe 350 index, which is the main stock index for European publicly traded companies. So really what that tells me is more evidence that the market likely is efficient. These are very smart people, these folks who run mutual funds, and the vast majority of them are unable to beat the market consistently. So that would tell me that, yeah, the market is likely reasonably efficient. And the other thing too, so if the market's efficient or reasonably efficient, what that tells me then is the most logical investment choice is by buying the whole market in low-cost index funds. When you invest in an active manager or mutual fund, basically you're opening yourself up to additional risk. So anyone who invests in the stock market already has investment risk, the risk that the stock market could go down. But when you invest in an actively managed fund, you're also opening up yourself to what I'll call managerial risk. The risk that the person managing your mutual fund will pick stocks poorly and you will perform even worse than the general stock market. So the stock market, the general investment risk for investing in the stock market is a priced risk. You get a risk premium for investing in the stock market because there's a chance you could lose money, but the expected value is going to be positive. When you invest in the stock market, you're not guaranteed a profit, but there is an expected profit from investing. When you're investing, when you open yourself up to managerial risk of, is your manager a good stock picker or not, that's risk that you're not compensated for, and it does not have a positive expected value. We just saw the majority of active managers underperform the market. So that's an additional risk that you're taking without additional expected value. So really, I'm not saying one way or another what you should do. I choose to invest in low-cost index funds because I've read the research and I've looked at the data, and I've come to a conclusion that it does not appear likely that investing in an actively managed mutual fund is going to provide me a better expected outcome than just simply investing in the index at the lowest possible investment fees. So the moral of the story is, before you make an investment decision, read the academic research and look at the data and look at all the hypotheses out there and come up with your own conclusion about what makes the most sense. And if you have a differing view of looking at that research and the data than I've come up with, I'd love to hear it in the comments. Please leave that for me. I'd really like to engage you on that. So that's my my best story of the week, my favorite story that I've written of the week. Now I'm going to close off with another segment, worst advice of the week. This is going to where I'm going to highlight some articles that I found on the internet that are just pretty terrible investment advice, and there is a lot of really bad investment advice and financial advice out on the internet, and a lot of very popular mainstream outlets as well. You're going to see a lot of people advocating for you to pick stocks and really get into some really bad things. So the headline I found here, and I won't say where because I don't want to call anyone out in particular, but the headline is, "Worried sick about a recession? Gold and power is the cure." I really hate this headline in this article for two reasons. One, it advocates investing in gold, which I'll leave that as a topic for another day, but I think is not an optimal investment decision. And two, it advocates that people try to time the market. It's right there in the headline, "Worried sick about the recession, here's what you should do." So, you know, there a lot of people have been talking recently about a possible recession coming, with the inverted yield curve, et cetera. But when you look at a lot of the underlying data, including employment information in the United States, nothing in there is screaming recession per se, and that it's a guarantee. But really, the long and short of it is, anyone who's saying there is a recession coming, they don't know what they're talking about. Nobody knows if and when a recession is going to take place or a bear market. Anyone who's telling you that they know that or implying that it's coming very soon and here's what you should do because of that is someone that I would not recommend you listen to. Let's go back to what I talked about investment decisions, is looking at the research and looking at the data. Nothing in that headline there is indicating that anyone's looked at any research or any data. If they have, I would be struggling to see how they come up with pull your money out of the stock market and put it into gold. There's just really, it's no way to be able to tell when the next recession's going to hit. And there's no way to tell when the stock market is going to crash, if that is to happen. I think a lot of people can get a lot of clicks and a lot of attention by having a headline that is suggesting the sky is falling and to put your money into gold. And I suppose it also was saying that you should put your money into individual energy stocks, which is a whole nother bag of crazy that I don't really want to get into right now. So the moral of the story, timing the market, it makes for a good story and a good headline, but in practicality, it's next to impossible to pull off properly. You have to be able to time it perfectly on the market on its way down to sell at the right time, and then you have to be able to time it perfectly on the way back up so that you get the gains. So timing the market, yeah, it makes for a good story, but again, go back to the data. Most people who try to time the market lose money. That's just the reality. The stock market is going to have declines from time to time. That's why you invest in a diversified portfolio. You don't go 100% into stocks. You diversify with bonds, etc. And knowing that, yeah, there will be some years where you'll be taking a paper loss. But the worst thing you can do is try to time the market and then have things blow up in your face. You sell everything going into gold, and then maybe gold collapses and the stock market keeps going up and up and up, and you've missed all those gains and you've got your money stuck in gold. That sounds pretty unappealing to me. So that's my worst headline of the week. I'm going to try to wrap this up, guys. I'm going to try to keep these at around pretty tight, around 20 minutes or so for these episodes. But again, this was my first YouTube live experience. I hope you guys have enjoyed this. The production value, etc. It's going to improve as we go along. This is really the first. We're kind of still experimenting with things here. So I'd love all your feedback. And I would really love to hear your questions. If you guys have investing or personal finance or money related questions or stress points, things that are really stressing you out, let me know. Shoot me an email or post a comment below the video here and ask those questions, and I can address them through this channel on a future episode, and I can also address them through my writing on Making the Millionaire. So if you haven't already, go check out Making a Millionaire. I'll post a link to that as well. And also post a link to the some of the scientific research papers around the efficient market theory that I've mentioned in my article. I really highly recommend you go check those out because they're really some fascinating information in there about if you're interested in how financial markets work. These are some really good papers in my opinion. So that's going to be it for me today, guys. I hope you enjoyed this, and we'll see you guys again next week.